The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to Pristine's webinar on swaps for FRM1 examination. So as you all must be knowing, swaps is a relatively important subject for FRM1, and you can easily expect around 3 to 4 questions from the topic in any given year. Also, swaps is a bit of a tricky subject to handle because it is very difficult to develop an understanding of the subject initially. So the basic mechanics of the swaps can be a bit difficult to understand. So hopefully through this blog we should be able to help the candidates prepare better for swaps. And help them understand the underlying concepts better. So before starting, I'd like to ask the attendees if they are able to hear me properly. So please feel free to give me a response in the chat as to whether you can hear me fine or not. So that would be great. Okay, so there don't seem to be any major issues with the audio, so we'll continue. So starting off, so basically Pristine is the provider for these webinars, and it's a leading financial trainer. It is authorized by the CFA Institute, the GUARD, the Premier, and it has a marquee client list of JP Morgan, Bank of America, Ernst & Young, and Calcutta, etc. So this is basically a very an attempt to provide you the candidates for FRM and CFA with a basic background on the more relevant topics that are included in these exams. So this is actually part of a series that we are running, which is not exactly covering the entire syllabus for these exams, but is trying to cover the basic concepts involved, or at least the trickier concepts involved in most of the topics. And also through these webinars we are trying to get a feel of what sort of topics and what sort of specific queries that the candidates might be having, so that we can address them better. Okay, so about me, then I am Hemang. I am in the content development team for Pristine. So I contribute regularly in their blogs. I help them make quizzes and often take webinars for them as well. Okay, so let's get started then. So this will be our agenda for today. We'll first look at what swaps basically are. Next, we'll look at the comparative advantage argument. Then we'll look at the interest rate swaps, then the valuation of interest rate swaps, currency swaps, valuation of currency swaps, then the type of credit risk that is prevalent in these cases, and other types of swaps which are in use. Okay, so let's talk about what a swap is basically. So a swap is an agreement between two parties to swap cash flows in future. So this is basically happens in a situation where there are two parties with somewhat similar cash flows, that is similar in magnitude, but they are different in their characteristic. For example, say there are two companies A and B, and company A has a say obligation to pay a debt that is paid at a fixed rate. However, they want to say, because of the concern of their board or some reason like that, they wish to get into a floating rate of payment. So they don't want to be paying a higher loan when the market is actually dictates that a lower interest should be paid on a loan. So that is one party, say A. So it has a fixed rate and it wishes, what it wants to do is go to a floating rate. So a fixed rate means that it will always pay out the same amount regardless of the market prevalent market rates. The floating rate will change according to the market rates. So here we have company A and here we have company B, which originally has a floating rate of loan but wants to get into a fixed rate of loan payment. So the reason for this could be that one reason could be often when boards or the management of a company wants to consolidate the position or wants to minimize the risks, they often try to go for a fixed rate of payment, because that way they are certain of the cash outflows from the company. So in a way their expenses are to a degree ascertained, as compared to floating rate where the expenses can vary from term to term. Okay, so we have these two companies. A has a fixed rate initially, B has a floating rate initially, and they want to change the payment structure to a floating rate and fixed rate respectively. So what happens in this case usually is they effectively pay each other's loans. So you will have A paying B's loan. So A will essentially pay the floating rate loan to B, and B will pay the fixed rate loan to A. So here what they are doing is basically changing the nature of their liability from a fixed rate. A is changing the nature of its liability from a fixed rate payment to a floating rate payment, whereas B is changing the nature of its liability from a floating rate payment to a fixed rate payment. So actually it's very important that you guys understand the basic concept that I'm discussing here. So please feel free to ask me any questions that you have at this point. I will gladly go over the concept again, because these concepts are very important to understanding swaps. So the arrangement covers swaps on multiple dates. That is, the swaps are basically the swap in the cash flow is conducted on multiple dates. Then the most common swaps are the interest rate swaps and currency swaps. So we'll be discussing them shortly. Then there's a legal agreement which the parties enter into. It's called the confirmation. It covers the termination date, the time that the swap will end, the calendar use, that is the Gregorian calendar or the financial calendar or any other different type of calendar, the rates of payment, the day count conventions, etc. So it sets a standard for the swaps to take place. Okay, so let's look at the comparative advantage argument then. So this is one argument for the existence of swaps. So this will show us how companies can use swaps to borrow funds at a lower borrowing cost. So this is an example of two firms, X and Y. So X has a fixed borrowing cost of 5% and a floating borrowing cost of LIBOR. So LIBOR is the London Interbank offered rate. This is usually used as the basis for floating rate transactions. So this is so most of the banks use this to basically determine the floating rate payments. Okay, so company Y has a fixed borrowing cost of 7% and has a floating borrowing cost of LIBOR plus 100 BPS. So BPS is basically basis points. So a very simple thing to learn here is that 100 BPS is essentially equal to 1%. So the floating borrowing cost for Y is LIBOR plus 1%. So we can just read this. Yeah. So what it says is that if these two companies engage in a swap, they can essentially lower their borrowing costs no matter what type of borrowing they want to conduct. They will be able to lower their borrowing cost. So here what we do is we look at the fixed borrowing cost first. So we'll see that X has an advantage compared to Y because it has a lower borrowing cost. So this is an advantage for X. And in terms of floating borrowing cost also, X has an advantage because it has a lower borrowing cost. For Y it's 1% higher. That is LIBOR plus 1%. And for X it's only LIBOR. Okay, so so X has an absolute advantage over Y when it comes to borrowing costs. But here we look at the comparative advantage. So if you see the difference in the borrowing cost between X and Y is 2% for fixed borrowing, and for floating borrowing it's only 1%. So here we can say that Y is the situation for Y is slightly better in case of floating borrowing costs. So if they are to engage in a swap, it would be ideal if X can engage and if X can take a fixed borrowing loan at 5% and Y can take a floating borrowing rate loan at LIBOR plus 1%. Okay, so one thing to remember here is that the combined benefit, that is the total reduction in the borrowing cost that will be attained by both the companies, can be calculated like this, that is delta fixed minus delta floating. So delta fixed is simply the difference in interest rates between the two for fixed borrowing, that is 7 minus 5 is equal to 2%. Similarly for floating, it will be LIBOR plus 1% minus LIBOR, so that is 1%. So the overall advantage to both the firms would be 2 minus 1, that is 1%. So I'll just show you in the next slide how this happens. So what would happen in this case? So we already know that in this case X will take a fixed borrowing rate loan at 5% and Y will take a floating borrowing loan at LIBOR plus 1%. Okay, so what they will do then is they will utilize the relative differences, that is the 2% present here and the 1% present here, to offer the loan to the other company at a lower percentage than this 7% or a LIBOR. So we'll just look at that. So what happens here is X will take a loan at 5%. So this means that X is paying a loan at 5% interest, and Y will take a loan at LIBOR plus 100 BPS, that is LIBOR plus 1%. So Y is paying a loan of LIBOR plus 100 plus 1%. Okay, so X, after taking a loan at 5%, will loan out the money to Y at 5.5%. So it loans out at a higher rate because firstly it needs to earn some income. It would be beneficial for X to earn some income this way, because it essentially is gaining 0.5% out of this transaction, right? And secondly, because even if it earns this money 0.5%, it is still offering the loan to Y, a fixed borrowing loan, mind you, at 5.5%, whereas Y would originally have attained this loan only at 7%. So Y is also clearly getting a loan at a fixed rate at a lower cost than it would have got from the market. So okay, so Y will be paying X at a rate of 5.5%. Similarly, Y, after taking a loan at LIBOR plus 1%, will be loaning out the money to X at LIBOR. Okay, so again, Y will try to gain some profit out of this transaction. So let's see the profit for Y. So the payment that Y is making is minus 5.5%. Another payment is for this loan, that was the original loan, that is will be LIBOR, say L plus 1%, and so this becomes minus. So it will also be gaining money at LIBOR, that is plus L. So overall the cost for Y would be minus 6.5%. Whereas, so this is the borrowing cost for Y at a fixed rate. So it would have originally gotten the loan amount at 4%, at 7% cost, but because of the swap, it is able to get it at 6.5%. So Y is also profiting by 0.5%. So if you add both of these up, you will get a total benefit of 1%. So this is an example of how a swap can lower the borrowing cost for the two parties involved. So please, at this point, I'd like to ask if anyone has any doubts on this particular concept. Please feel free to ask, or I would even be able to repeat this if anyone has any doubt, because this can be a bit difficult to grasp initially. So feel free to ask me about that. Okay, so now let's look at a question on this. So these are the two companies, ABC and XYZ. ABC has a comparative advantage for fixed rate loan, and XYZ has a comparative advantage for fixed rate loan at 10%, and ABC has a comparative advantage for floating rate loan, that is LIBOR plus 1%. So how would they benefit from an interest rate swap? Okay, well, in this case it's pretty straightforward. We'll do the same thing we did the last time. So XYZ would take a loan at 10% fixed rate. So as we can see here, XYZ is taking a loan at 10% fixed rate. Similarly, ABC will take a loan at LIBOR plus 1%. So here we have ABC taking loan at LIBOR plus 1%. Okay, then XYZ will loan this money to ABC. However, here we have introduced the concept of a IB, that is an investment bank, or in other cases it can be some other financial intermediary, which actually carries out the transaction involved in the swaps. So as a fee for carrying out the transaction, the IB will take off a 0.5% of the profit here. So if XYZ is lending the money to ABC at 10%, IB will take off 0.5% from that, and essentially XYZ will be loaning the money to ABC at 10.5%. Similarly, ABC will loan the money at LIBOR plus 1%. The IB will again take off around 1.5% of the profit, that is 150 BPS, and loan the money to XYZ at LIBOR plus 250 BPS, that is 2.5%. So as a result of the swap, we are seeing that XYZ initially had basically a fixed rate of payment, and if it wanted to go to a floating rate, it would have had to pay LIBOR plus 3%, whereas now it is paying for the floating rate it is paying LIBOR plus 2.5%. So you can see here that due to the swap, the XYZ was able to reduce its borrowing cost and also change the nature of its liability. So while it took a fixed rate loan from a financial institution, it is receiving the payment for that fixed rate loan from ABC. So it no longer needs to worry about payments on that fixed rate loan. It will now only need to consider this floating rate loan that it has essentially taken from ABC. So here we can see that the nature of the liability was changed from a fixed rate to a floating rate for XYZ, and also the borrowing rate was reduced. So this is a example for this is a case for the comparative advantage. Okay, now let's look at the major kinds of swaps. So starting with the interest rate swaps. So the most common kind of interest rate swap is a fixed for floating interest rate swap. So what happens here is two parties get into an agreement with one party paying the other at a floating rate and the other party paying the original party at a fixed rate. So this usually happens when two organizations have different nature of liabilities. One has a fixed rate liability, other has a floating rate liability. So and they essentially want to switch those. So in that case, and also the magnitude of the liability needs to be almost the same. In that case, they can engage in a swap. Okay, so let's look at an example here. So we have party 1 that has the opportunity to avail of a fixed rate loan at 10%, and party 2 has the opportunity to avail of a floating rate loan at LIBOR plus 0.3%. So what happens is, and also party 1 would be wanting to switch to a floating rate liability, and party 2 would be wanting to switch to a fixed rate liability. So party 1 in this case will simply loan out the money at 8% to party 2, and party 2 will loan out the money at LIBOR to party 1. So in this way, basically, so party 1 will now have a liability to pay out the money at LIBOR minus 2%, and party 2 will have the liability to pay out the money at 8.3%. So as you can see, the nature of the liabilities for both the companies has been switched. Party 1 was initially able to take a fixed rate loan of 10%. Party 2 was able to take a floating rate loan of LIBOR plus 0.3%. Now party 1 can take a loan, is effectively taking a loan of LIBOR minus 2%, and party 2 is effectively taking a loan of 8.3%. Okay. So let's look at a question. So which of the following achievable swap positions could be used to transform a floating rate asset to a fixed rate asset? So this basically means how would you transform a floating rate liability to a fixed rate liability? That is, you are initially paying floating payments according to a floating rate. How do you change that to payments paid by a fixed rate? So the answer here is you pay the fixed rate leg and receive the floating rate leg of a plain vanilla interest rate swap. So this is the swap that we were discussing right now, the plain vanilla interest rate swap. So if there are two parties, if there is A and B, with A paying say fixed rate and B paying a floating rate. So this means that it is in their current position, A can attain a fixed rate loan and B can attain a floating rate loan, and they want to, so according to the question, B wants to switch the floating rate loan to a fixed rate loan. So they will simply engage in a swap, and B will receive the fixed rate loan, and it will, sorry, B will pay out the fixed rate loan and it will receive the floating rate. So this is how the liability or the asset nature will be switched. Okay. So again, I'd like to ask if there are any questions that anyone has. Please feel free to ask them. Okay, so we have another question here. So there is a 3-year term for a swap. There is annual payment. The fixed rate is 5%. The floating rate is LIBOR plus 1.5% or 150 BPS. The notional principal is $10 million. So we have to calculate the net coupon exchange for the first period if LIBOR is 6% at the beginning of the period and 6.5% at the end of the period. So we are only concerned with the first period in this case. So I'll give you around 1 minute to try this out, and then we can take a look at the solution. Okay, so let's look at the solution. So basically, this is the solution in this case. Okay, so how do we get that? So we have a fixed rate payment of 5% and a floating rate of LIBOR plus 1.5%. So we need to calculate the net coupon exchange. That is what is the overall transaction that will be occurring. So for the fixed rate pair, what is happening is it is paying out interest at 5% of 10 million, and so this is the inflow, and this is the outflow, and the inflow would be based on the LIBOR plus 1.5%. So the LIBOR is taken from the starting of the period. So at the starting of the period, the LIBOR was 6%. So that would be 6% plus 1.5% of 10 million. So this will basically give us the answer. So this will be 500,000 and this will be 750,000. So essentially the inflow is greater than the outflow, and it is greater by 250k. So basically the fixed rate pair will receive $250,000 in this case. Okay. Okay, let's look at the financial intermediaries. That is the investment bank that we saw a couple of slides ago. So how do they operate? So in the practical world, most swaps are traded in the OTC market, that is the over-the-counter market, or you can consider that swaps are traded outside of the exchanges. So as a result of which swaps are very customizable, that is they can be changed based on the parties conducting the swap. And there is also, as a result of the non-standardization, higher risk of default, even though the payment is for swaps is relatively lower compared to other securities. So as a result of these risks, we have these financial institutions which basically guarantee or at least improve improve or rather decrease the probability of a default, and as a result they take to provide these services, they take a chunk out of the profits. So here we have a case. Party 1 is taking a loan at 10%. It is providing loan to party 2 at 9.985%, but the financial institution for providing its services charges around 0.03% of the profits. So it's essentially available to party 2 at a higher rate. So here basically the financial institution is taking 0.03% of the profits from this transaction. So this might look like a small number, but for very large transactions in the orders of million and billions of dollars, this can actually lead to a pretty decent profit for the financial institutions. Okay, so yeah, so the intermediaries usually create a market by bidding, by creating both bid and offer positions, so that it can see clients on either side of a swap. So in most of the cases, the parties that actually engage in the swap are not aware of the other party's existence. They primarily transact with the financial institutions only. So basically party 1 would only be aware of this part of the transaction, whereas party 2 will only be aware of this part of the transaction. So they would not actually be usually be aware of the other party involved. Okay, so swap rates. So swap rate is a simple average of the fixed rate of a market maker is prepared to pay. That is the bid rate in exchange for receiving the floating rate, and the fixed rate it is the market maker is willing to receive. Market maker is basically the financial intermediary. So the fixed rate it is willing to receive in return for payment of floating rate. That is its offer rate. So basically the bid and offer rates, if we take the average of these two rates, we'll get the swap rate. Okay. Then we come to the valuation of swaps. So before going into this, we would be requiring a knowledge of the principle of continuous compounding, because valuation of derivatives is done on this principle. So the normal compounding is not considered. The continuous compounding of payments is considered here. So if you could reply on the chat whether you are aware of this concept or not, that would be great. So based on your responses, I'll take up this. I'll either take this up or I'll leave it up to you guys. I trust you guys must be knowing this topic otherwise. Okay, so I think it would be better for me to take this up since people don't seem to be aware of this concept. Okay, so if you can recall very basic compounding, what happens in compounding is that is time value of money is, we have this formula. So to get the future value, we just take the present value and multiply it by 1 plus r by m into 100 to the power n by m. So r is the interest rate here, n is the number of years, and m is the frequency of compounding. So what happens in this case, so here we would primarily be concerned with finding out the value of the present value of payment. So we would be interested in finding out this value. And what happens in continuous compounding is that the frequency of compounding is constant. That is, every instant the payments are getting compounded. So what happens to m is basically the limit of m goes to infinity. So in this case, if you might recall the concepts of limits and continuity, the formula transforms to this r into n. So basically, in case of continuous compounding, we only need to use this formula. That is, we'll take the future value or the value at present, and we will discount it back. In order to discount it back to a particular time, we just multiply it by the exponential of minus negative of the rate of interest and the number of time periods. This is the time periods. Okay, so using this concept, we will value the swaps in the following slides. Okay, so now let's look at how they are basically valued. So this is the equation that is used to value the swaps. So based on which party we are valuing the swaps for, we'll use either this formula or the opposite, that is this. So this is basically B fix here is the present value of the fixed rate payments, and BFL is the present value of the floating rate payments. So if a company has a cash inflow of the fixed rate payments and an outflow of floating rate payments, we will use this formula. And if the company has an inflow of floating rate payments and outflow of fixed rate payments, we will use this formula. Okay. Okay, so let's look at a question here that will be very helpful in your understanding of the concept. So a bank has entered into a 3-year interest rate swap for a notional amount of $300 million at a fixed rate of 7.5% per year. And it is receiving LIBOR annually. Just after payment was made at the end of the first year, the continuously compounded 1-year and 2-year LIBOR rates were 7% per year and 8% per year respectively. So we need to find out the value of the swap at the time mentioned. So what is happening here is a bank basically is has a cash outflow at the rate of 7.5% per year and a cash inflow of LIBOR. Okay, so basically what we'll do here is we will find out the present value of the outflows and the present value of the inflows and find out the value of the swap that way. So if you can see, this is a 3-year interest rate swap. So and this is talking about the time just after the payment was made at the end of the first year. So we are here presently. What will happen now is, first considering the outflow of payments, what will happen is the bank will make a payment of 7.5% of the notional amount, that is $300 million of $300 million at this point, and another payment of the same amount at the end of 3 years. Plus it will also be paying back the principal, that is $300 million. So we have one payment at the end of 2 years, which will be this, and one payment at the end of 3 years, which will be the principal amount plus the same interest payment that was paid at the end of 2 years. So the value of, so the PV of the outflows would be, we'll have 7.5% of 300 million, and we will have to discount it back to 1 year because it was paid at the end of the second year and we are presently at the end of the first year. So we will discount it back 1 year. So the rate that we'll be using is the continuously compounded 1 year LIBOR rate. So that would be 0.07. And the number of time periods is 1, so we'll just have this. Now for the next payment, that is at the end of 3 years, what we have is the same amount, that is 7.5% of 300 million plus the principal that is also paid, and this whole payment will be discounted for 2 years because it is being paid at the end of 3 years, whereas we are presently at the end of the first year. Okay, so we'll discount it like this. We are multiplying it by 2 because we are discounting for 2 years. Here it would be multiplied by 1 because the discount was for 1 year. So this way we'll get the value of the present value of the outflow. Similarly, we will get the present value of the inflow. Now, for the present value of the inflow, Yeah, so the answer is actually US $4 million. So to calculate the present value of inflow, we can use a very useful tool. So what happens in case of floating rate payments is, if you would recall what we know from bonds, is that whenever the coupon rate is equal to the interest rate that is prevalent, the bond price will be equal to the par value. So if the interest, so for the floating rate, what happens is after every say year, the coupon rate will be revised to match the interest rate. So interest rate in this case will be the LIBOR. So say after 1 year and after 2 years, after 1 year and after 2 years, the interest rate will be revised to match the LIBOR values. So basically what we can say is, for the floating rate, we are presently here, and what we can say is that at the end of 2 years, the value of the bond will be the par value, that is $300 million. So I hope this was clear to everyone. So based on this, what we can do is, so here then this simplifies our task, because we only have 2 payments to consider here, because one payment will be at the end of the first year, which would be the value of LIBOR, that is 7% based on this value. So PV of inflows would be the 7% of 300 million that is paid off, this will be discounted at 0.07, and we'll also have the 300 million payment, which will also be discounted at 0.07, because they are both coming at the end of the second year and we are discounting it back to the first year. So when you compare these two values, PV in minus PV out will give you $4 million. That is the answer. Okay, so next we'll look at the currency swaps. So what happens in a currency swap is there are 2 different firms which have a liability in different currencies. So say one is a US based firm and one is a UK based firm, and they'll be having their liabilities in different currencies. So there might be a case where the company in US would want to avail of of a loan in UK, and a company in UK would want to avail of a loan in US. So what happens in this case is, whenever you apply for a loan in a foreign country, you usually get a higher interest rate at which you have to borrow. To avoid this situation, companies often engage in a currency swap. So as an example, here we have a currency swap between party 1 and 2. So party 1 is based in India and can borrow in rupees, and party 2 is in Australia, can borrow in Australian dollars at 6%, and party 1 borrows 380,000 rupees at 12% and exchanges the principal with the party 2 for 100,000 Australian dollars. So the principal is exchanged back at the end of the life of the swap, and the life of the swap is 5 years. So what happens here is similar to the case we discussed earlier. Party 1 wants to change its liability from the payment in Indian rupees to a payment in Australian dollars, and party 2 wants to change its payment from a payment in Australian dollars to a payment in Indian rupees. So what they do is basically they pay each other's loans. And because the exchange rate between the two currencies is cannot be constant, it will definitely change. In order to safeguard each other's positions, what happens is at the end of the swap, the principal amount is exchanged. So they exchange the principal amount. So party 2 will give 100,000 Australian dollars to party 1, and party 1 will give 380,000 Indian rupees to party 2. Okay, so I hope this is clear to everyone. Okay, yeah, so we'll next look at the valuation of currency swaps. This is very similar to the valuation of interest rate swaps. The major difference is that there is an exchange rate between the two currencies. So what we do here is we value the present value of the payments in one currency, and we subtract it from the present value of payments in the other currency, and before subtracting, we'll multiply it by the exchange rate to convert it into the same currency. So this is pretty straightforward. I think we can look at a question on this to help understand the concept. So here we have a case where the US interest rate is 6% per annum. The Indian interest rate is 8% per annum. Assume that the term structure of interest rates is flat in US and India. That is, the interest rate does not change with a change in yield, as it changes constantly with a change in yield. Assume the current value of Indian rupee to be 0.02 US dollar. So this is the spot exchange rate. Company ABC, under the terms of swap agreement, pays 7% per annum in Indian rupees and receives 3% per annum in US dollars. So the principal in US dollars is 10 million, and that in Indian rupees is 550 million rupees. Payments are exchanged every year, and swap will last for 3 years. So determine the value of swap assuming continuous compounding. So what is happening is, say there's a US firm and there's an Indian firm. US firm can take a loan in US at a rate of 6%. The Indian firm can take a loan in India at a rate of 8%. The current spot exchange rate is given, and so they engage in a swap wherein the US firm is loaning the money out to India at a rate of 7%, and India is loaning out, the Indian firm is loaning out the money at a rate of 3%. Okay, so so based on this, we can find out the monthly payment. So this will come out to be 0.03 $0.3 million cash flow and in dollar terms, and 38.5 million cash flow in rupee terms. So we will simply discount the values using the continuous compounding. That is, we'll use this formula for US dollars, that is 0.06 T, and we'll use this formula for Indian rupees, that is 0.08 T. So using these cash flows and this discounting factors, we can get the present value of the payments. And eventually we'll also be there will also be an exchange of the principal payments, so that is also shown here. So based on the sum of these present values, we can simply get the present value of the swaps in the different currencies. Then we'll convert the rupee, the present value of the rupee payments into the dollar value, and we'll subtract these two values to get the value of the swap. So this will be $1.47 million. So I will actually be sharing the Excel files containing the solutions for these questions in case you have doubts. Okay, so let's look at the credit risk. So a financial institution has a credit risk exposure from a swap only when the value of the swap is greater than 0. This exists because any company that is transacting with the financial institution might not be able to pay it back, and as a result it exposes the institution to financial risk. So yeah, in swaps the potential losses are much less than loss from defaults on loan, because the amount is much lesser. The amount that is to be paid, that is much lesser. Yeah, and potential losses from a currency swap are much higher than losses from an interest rate swap. This is primarily because of the payment of the principal that is exchanged at the end of the swap, at the termination of the swap contract. So in the interest rate, whereas there is no exchange of the principal is only notional, and the principal is used only to determine the value of the payments that will be exchanged between the two parties that are engaging in the swap. Okay, then let's look at the other type of swaps. LIBOR is the most common floating rate in interest rate swaps, but yeah. So let's look at there's a floating rate, floating swaps. So floating swap is like one type is the LIBOR. So where one rate of one type, that is LIBOR, can be swapped with floating rates of another type. So basically in this case, floating swaps, both the parties have a floating rate of interest, and they exchange the payments based on that. So there is no fixed rate of payment in this case. Okay, then we have the amortizing swap. So as you can get from the name itself, the amortizing swap, in the amortizing swap, the principal amount will reduce at a predetermined amortization rate. Next we have the step-up swap, where the principal increases in a predetermined way. And we have the credit default swap. So here actually the buyer of the swap will pay a premium to the seller. That is because the seller will essentially guarantee a low probability of default. So as long as the seller does not default, the buyer will pay a premium. If however the buyer defaults, then the seller of the swap will make a payment to the buyer. So the opposite will happen, and the default swap will be terminated. So this credit default swap essentially protects the buyer from a default in payment. Okay, next we have the compounding swap. here what happens is the payments are not made on a periodic basis, rather the payments are compounded to the end of the contract and are paid at the end only. So there is no intermediary payment of swaps. Then we have a fixed for floating currency swap. So here again it's very intuitive from the name. The fixed rate of interest in one currency is swapped for the floating rate of interest in another currency. So earlier, as in the question that we saw, the case was of a fixed for fixed currency swap. This is fixed for floating currency swap. So in one currency, the rate of interest will be floating. Then we have an equity swap, that is an agreement to exchange the total returns from an equity index for a fixed or floating rate of index. So on one side you will have the returns from an equity or a share or a group of shares, and you will swap it with a fixed or a floating rate of interest from a, say, a debt instrument. Then you have a puttable swap where one party has the option of terminating the contract early. So again, as is usually the case in a puttable swap, the price of the swap would be higher for the party which has the option to be able to put the swap, that is terminate the contract early. Next we have swaptions. So swaption is a hybrid of an option and a swap. So it's basically an option on swap which provide one person with the right at a future time to enter into a swap where a predetermined fixed rate is exchanged for floating. So basically swaption will give you an option to enter into a swap at a future time. So based on the market position at that time and your personal inclination, you can either choose to enter into the swap, or you can choose to not exercise the option and not enter into the swap. Okay, so I think we are done with all the topics intended for today. So if you guys have any questions, please feel free to let me know on the chat. Otherwise, I can discuss about the webinars that we'll be conducting, as I was mentioning at the beginning. So these are actually the blogs from some of the webinars that we conducted previously. So these basically will help you to gain a good foundation into the topics and would prepare you for at least the basic questions in each of the topics. For a more thorough understanding, in case you feel that these are not sufficient for you, please let us know. I'll be sharing my email ID with you shortly, and please let us know if you require a more detailed description of these topics or any of the topics covered, and if there are a sufficient number of people who require that, we will definitely go ahead and conduct webinars or release newer blogs on them. So yeah, so other than that, for the New York audience, in fact it's New York, Chicago and Boston. So for the audience in these three cities, we'll be conducting classroom training starting from 3rd May. So it will be basically a review course which would be very helpful in helping you cement your understanding for the upcoming FRM examination, as it's very close by, only 3-4 weeks left to the exam. So I would definitely encourage people in New York, Boston or Chicago to attend these programs. Other than that, if anyone has any concern, please let me know on the chat. If not, then thanks for attending the webinar, and we'll keep you posted for any further webinars that we'll be conducting. Okay, so everyone seems to be pretty content, so let's end it here then. Okay, Thank you guys. Thanks for attending the webinar.